What if I told you there exists a company so influential and pervasive that it impacts nearly every aspect of your life? A company with such vast wealth that the assets it controls surpass the GDP of all countries on the planet with the exception of two. A company that is the single largest investor in the destruction of our planet's forests and the leading financial contributor of the fossil fuel industry. And what if I told you it is likely that you yourself contribute to the funding of this company and enable it to carry out its actions? And even if you tried your best, it would be completely impossible for you to stop providing them with funding and contributing to their widespread control and influence. The scary fact is that this company does exist and you have most likely never heard of its name before. That company is BlackRock. In this video, we will provide an in-depth look at the true ownership structure of the planet and the institution that controls almost every aspect of our lives. We will also explain why they are predicting with absolute confidence that we are headed towards a multi-year recession and one of the worst depressions of our lives. But before we jump into the video, if you enjoy finance content, all I ask is you consider hitting that like button or subscribing to the channel. It means a lot and helps us put out daily content. And let's get into it. So, there's a good chance you've never heard of BlackRock. Established in only 1988, in only 30 years this American financial firm has grown rapidly to become known as the company that owns the world with assets totaling $10 trillion. But that's not all. In addition, BlackRock created a software platform called Aladdin which is used to perform risk analysis for its clients. Through this software platform, Aladdin, BlackRock gains access to sensitive data from banks, insurance companies, and other important institutions all over the globe. Thanks to Aladdin, BlackRock has insight into the management and data of financial assets worth an additional $20 trillion all over the world. This means that not only does BlackRock have the most power and control in terms of assets held under its management, but it also is the most informed institution regarding what is going on in the global economy and what that means for the future. So when they are predicting that in 2023 we are heading for a deep recession and global depression, it's best you listen. BlackRock is warning investors of a recession like no other and warning that what has worked in the past will not work now. The world's largest investment manager has gone all in and says a global recession is right around the corner and don't expect the central bank to save you, as they believe the financial tricks deployed by central banks in the past won't work this time. According to BlackRock, the global economy has entered a phase of elevated volatility and that a recession is imminent due to central bankers aggressively boosting borrowing costs to tame inflation. Their actions, according to a team of BlackRock strategists, will ignite more market turbulence than ever before. And they're not wrong. The cycle we have gone through in 2022 was the most aggressive rate hike cycle in history of modern economics, and what's different today is that it's not just the Federal Reserve doing this. We're seeing central banks around the entire globe raising interest rates at the fastest pace they've ever done, which is going to have huge, long-lasting consequences for the markets. Consequences that are going to take years to work through the system. Another problem that BlackRock is predicting is inflation. BlackRock believes higher than expected inflation will be widely seen throughout 2023. They believe that although it appears inflation is pivoting, we are actually going to see a double peak in 2023 with inflation coming back more heinous and destructive than before. And this isn't a prediction only held by BlackRock. Famed investors and men with their finger on the pulse of the global economy, men such as Michael Burry, Elon Musk, Jeff Bezos, and Chamath Palihapitiya are all predicting this exact same scenario in 2023 and sounding the alarms to investors. Now, you may be asking who is the puppet master behind the scenes of BlackRock, the institution with the most control, influence, and power in the entire world? Who is the man at the helm of the most powerful company on the planet with access to the most data making these predictions? Well, that man would be Larry Fink, the CEO and chairman at BlackRock, and earlier in the month he did an interview speaking on exactly why he believes we are heading into further recession in 2023 and why inflation will stick around for years longer than most expect.
What's the chance of a recession? And not so much this year, but in 2023 or even 2024?
I could see scenarios where it could be quite bad, another downward draft of significance. And that's going to be dependent on earnings going forward. But I could also see a scenario where we're going to be muddling along for the next year or two, right around this level. And, maybe up 5%, down 10%, but we're going to be in this range-bound area until we have better information. I mean, the one thing I will say with total certainty, we're going to be living with more uncertainty. And so with that in mind, we are going to have bouts of fear, which is going to bring down the markets and a little more confidence going on forward. But we have not witnessed huge asset allocation changes by our investors. Obviously, there are views that we could have a deep recession or a hurricane, but that's just one of the outcomes. I mean, I think there's higher probabilities of outcomes that we're going to be more range bound with a lot of volatility. The market has recalibrated itself. We witnessed now a change in policy in the Federal Reserve. We raised short rates. We saw a recalibration of growth stocks. That's principally the majority of the downfall, and yet the index are masking some of the problems because part of the index are energy companies, commodity companies that are up quite a bit. So if you look at the volatility in the market and the spread between winners and losers, it's pretty broad this year. And so we've taken out a lot of those gains that we saw during the COVID years and during the 2 years where we were changing our lives and we were emphasizing different companies. And now we're seeing the reverse impact of that. So that was one of the foundations of it. But now there's greater recognition that inflation is not transitory. It is probably with us for a number of years. And it's the type of inflation that I don't believe the Federal Reserve has the policy or the tools to do much with it right now. And I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated. Demand right now in our economy is equivalent to the demand that we saw pre-COVID. And so we're witnessing all these supply shocks, and that's creating these attended price increases. And so it's more supply driven. It's been aggravated now, obviously, by COVID and lockdowns in different parts of the world where we are manufacturing goods. It has been further aggravated by the Ukraine Russian war and where we have supply shocks. But I have this fundamental view that much of the inflation has been generated by some very large policy shifts in the United States. I believe the problems of inflation are not Fed related as much as policy related. So I believe inflation is really based on some big macro policy changes that had good intentions, but the unintended consequences are more inflationary. For instance, post-World War II, America's foundation of economic policy was based on consumerism. We built this entire economy post-World War II with a belief that if more Americans can have more things, then we have happy Americans, and we built a whole geopolitical platform around that. And then with the fall of the Soviet Union and we had the peace dividend, we were able to accelerate globalization and building things. And that's one of the fundamental reasons why we had deflationary pressures for the last 30 years, that whole movement towards supply chain navigation and lower prices. I would say 10 years ago, the rise, whether you call it nationalism or the rise of this belief that we have to focus on communities that have been devastated by globalization. We need to find ways of creating better jobs for more Americans. That in itself is inflationary when you move away from the cheapest price ever to another area. And so that's a fundamental change. We changed our immigration policies, and I'm talking about legal immigration, okay? Our legal immigrations, that was changed about 5 years ago, where we reduced the amount of legal immigration. If you look at the rate of increase of immigrants, legal immigrants in the United States from 2000 to 2017, and the rate that we are growing immigration in the last 5 years, we're down 2 million. 2 million new entrants to the United States legally. That is very inflationary when we have full employment, when we have these jobs. Think about all the need for workers. What does that going to mean when we start implementing our infrastructure bill, when it's going to take up quite a few new jobs? Where are those employees going to be coming from? It's going to create rising wages. And if you look at earnings, many companies are saying rising wages are a part of their degradation of their margins. And let's be clear, the $7 trillion, I want to underscore, $7 trillion of fiscal stimulus during the COVID years, is beyond any stimulus we've ever seen in fiscal policy in our history of a country. So you add all those things up, it was a foundation of inflation. And then you overlay the Russian-Ukraine war and the supply shocks, and then you overlay now COVID and the lockdowns and what it's doing for supply chains. All of that is adding on. So getting back to the Federal Reserve and your question, the Federal Reserve does not have tools to fix supply problems. The Federal Reserve's tools, like every other central bank, is to reduce demand through higher interest rates. As I said, I don't think we have a demand problem. We have a supply problem. And so if they believe they have to change demand, that will put us into a recession. And I believe we need more time. So I'm under the belief we're going to have a 2-year period of time of elevated inflation. But I do believe as we reconstruct our supply chains, we find better sources of energy in the interim, as we create more decarbonization technology, all of this in 3 or 4 years is going to work itself out. Well, I think we are living in a 4% or higher inflation world for the next 2 years. Investors are going to have to look beyond this period. The question is, what will happen in 3 or 4 years? Is this going to be a short-term pop? I mean, you even heard one of the governors yesterday talk about, we need to raise rates a few more times, and then I could see in a year we're going to lower rates. Okay, in my opinion, we need to get to a 2% level, just a level set, and let the data determine where it is. But I do believe, because this is supply generated and policy generated, not as much monetary policy generated, it's hard for them. If they overshoot, we'll definitely get into a recession, and then they're going to have to ease very quickly, and we still may have the supply problems. And in all the conversations I have with business leaders around the world, and I've had a couple meetings in the last 2 days with some significant CEOs of major international companies, and they're all talking about the supply problems, and they're also talking about the need of labor, and they're all seeing this problem, and it's a real big issue.
So there's Larry Fink speaking on why he believes a deep recession is coming in 2023. Of course, being the public figure that he is, he can't come out and fearmonger, with him having to choose his words carefully to not cause public panic. He has to blend in the scenario he truly thinks will play out, a deep drawn-out recession, with that of other less scary eventualities, such as market sideways for a year or two. Now, the main and most pernicious issue Larry Fink and BlackRock believe are ravaging economies globally is that of inflation. Larry Fink believes that we're going to see 2 years of heightened inflation, and that the Federal Reserve doesn't actually have the tools this time to fight back. And it's not a trend that only BlackRock and Larry Fink are predicting to happen. In just the last 2 months, Elon Musk, Jeff Bezos, Michael Burry, and Chamath Palihapitiya have all predicted that the most likely outcome for 2023 is another large spike in inflation. And if we look back to the history books, it's easy to understand why. Going back 100 years, you can see that inflation doesn't just appear in one-off solitary spikes. However, it appears in multiple years, spiking once, resolving, and then coming back even worse. You can see this most poignantly in the 1940s and then again in the 1970s. This is because this is the nature of inflation and the velocity of money, and you best believe that the world's richest men, as well as BlackRock and Larry Fink, have caught onto this trend and are already preparing. In fact, in BlackRock's 2023 Global Outlook report, they wrote, "Recession is foretold as central banks race to try to tame inflation. It's the opposite of past recessions." They believe that the global economy has already exited a 4-decade period of stable growth and inflation and has now entered a period of heightened instability. And they've got that completely correct. It is accurate to say that over the past 40 years, the middle class has experienced a relatively good standard of living compared to previous times in history. However, over the past 40 years, the standard of living has slowly but surely been eroded away, and now even those who make 70 to 80,000 or even 6 figures are not able to maintain a high standard of living with that income. Many people are struggling to afford basic necessities like rent, food, and utilities on incomes of $70,000 to $80,000. Many people believe that the worst of inflation is behind us, however they are in for a rude awakening come 2023. And that's not the only pain BlackRock predicts is ahead. Further in the report they write, "Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. Equity valuations don't yet reflect the damage ahead." So BlackRock believes that investors are still delusional that when things get bad this time, the central banks will step in to save the day. And why wouldn't they think this? Ever since 2008, investors have gotten completely drunk on money printing and quantitative easing, with any recession fears being printed away by the Federal Reserve. But with inflation lurking and interest rates already so low, BlackRock predicts that this time the Fed won't be the hero coming to save the day like the market has come to think of it. It is likely that in 2023, investors will slowly come to the realization that the Federal Reserve will not be able to save the day, and this realization will lead to a recognition that we are likely to experience a severe multi-year recession. Once it has slowly dawned on investors that this crash is not like the ones we have seen in the past 15 years, company earnings are expected to plummet, sending the market in a downward spiral. The strategies of the old playbook that has worked for the last 15 years of buy the dip, buy the dip, buy the dip will not work this time around, as we have begun a new regime of sharper trade-offs, sticky inflation, and greater macro volatility. The warning from BlackRock echoes those from Morgan Stanley, Bank of America, and Deutsche Bank, all which have produced dire predictions ranging from a 20% stock plunge in 2023 to Goldman Sachs seeing a 65% chance of recession. So there you have it guys, the most powerful and influential institution in the world giving small hints and predictions of a looming recession and depression for those savvy enough investors to go and find them. If you enjoyed today's video, all I ask is that you consider liking the video or subscribing, as it will help us put out daily content for you all. Anyway guys, I'll see you all in the next video, and as always, all the best.